Very good afternoon, good morning. Welcome to HYCM's workshop with myself, Giles Coughlin, a Chief Currency Analyst. Very warm welcome to you. Glad you could make it here. Nestius, well done. Warren, good to see you as always. I do hope everyone's doing okay and looking forward to just taking us through this session. I want to just summarize where we're at in markets, as well as looking at that latest Canadian CPI print and the Japanese inflation print. Got a few moving parts that we really need to get on top of. You can just let me know you can see my screen and hear my voice okay. That would be good, so I know I'm coming through loud and clear. Everything seems to be okay and set up fine my end, so that should all be working. Just as we get started and as folks come into the webinar, don't forget that as we look at different entries and exits, the whole idea of this workshop is that it's not a signal trading service, an educational service. So the idea is you look over my shoulder, someone with a professional trading background, and you see how I go about making trading decisions, choosing currency pairs. As I've said numerous times, but you can't really stress it enough, the most important aspect when you're trading is to grasp this knowledge that you're wanting to trade strength against weakness. Look to back the strong currency against a weak currency. That's the way of putting probability in your favors, just as we would look to back a strong arm against a weak arm in an arm wrestle. We'd always expect the bigger arm to beat the smaller arm. That's just common sense, isn't it? It's a bit like in boxing, whenever you have boxers fighting, they're always divided very carefully into weight categories. Why? Because the heavier and the bigger you are, the more of a punch you pack. And so we know that it's absolutely unfair to have a heavyweight boxer fight a flyweight boxer or a middleweight boxer. So whenever we're pairing up matches to have an even as fight as possible, we want fighters about the same weight. That makes it more even. It's exactly the same concept that we need to embrace when we're trading, except we're looking to trade a strong currency against a weak currency. We don't want it to be a fair fight, as it were. We want it to be very clear. So just as this picture, we want a weak currency against a strong currency, we want the strong versus the weak. That's the whole idea. And we often look at upcoming economic data points to find situations where suddenly that strength or weakness might appear. Okay, that's really what we want to see. We want to see reasons for that strength and weakness. So we're going to embrace that thinking, and with that philosophy, firmly under our belts, we're going to take a look at the charts. And we've got a few significant events, not just these two. We've also got Jerome Powell's testimony, which I want us to look at as well. So don't forget, you can ask questions during the chat. Just put in the Q&A box or the chat box. Just feel free to ask your questions as we go through. And I think most people have now signed in to the webinar. So without further ado, we will get going. Let's just, I'm now going to go over to the main screens. Okay, so let's just drop this line in. Yes, okay. It's important we have a quick recap. So today, markets have started off risk off. We can see markets are risk off because equity markets are trading lower, in line with the negative sentiment we have at the moment. As the Federal Reserve is hiking interest rates, that makes conditions harder for companies to generate profits. With inflation higher, it means consumers have less discretionary spending. So with companies' profitability likely to be hit on higher debt repayments, with consumers having less discretionary spending, with the prospect of interest rates rising, which makes conditions more difficult for companies and makes mortgages more expensive for consumers, there's less disposable income around, so market conditions are expected to be negative for equities, which is why we've seen equities falling lower pretty much since the start of the year. We've had these selling pressures in major US equities and followed around other equities apart from China's 50. And China's 50 is in a different place, as we've mentioned many times, because China's 50 is seeing stimulating response from China's government. We've got large-scale infrastructure projects. We've got tax breaks, and we've had 40% falls in China's 50 index already. The People's Bank of China is looking at cutting interest rates. The reserve ratio requirement has been reduced a number of times over recent weeks, and expectations are that China's 50 index can recover nicely, and we would anticipate prices moving over the next 12, 18 months back up towards that 1800 region. So there is a medium-term upside for China's 50, and we're waiting now to find out where a stock's going to bottom. Now, this is the first potential opportunity that we have. Later on in today's session, we have Jerome Powell speaking at the semi-annual testimony at Congress. Now, if you remember the Federal Reserve's interest rate decision last week, what did we see? We saw stocks selling off. And if you remember, the reason we saw stocks selling off is because Jerome Powell was telling markets he was prioritizing inflation. Do you remember 2 weeks on Friday, we had that high US inflation print, came in at 8.6% for the US, and that spooked the Fed, and the Fed all of a sudden decided to hike by 75 basis points to try to bring that inflation down as quickly as possible. So what the Fed signaled was that inflation is their #1 priority. But it's never that simple, life, because it's not a question that the Fed can, focus on inflation but ignore growth, or focus on growth and ignore inflation. In reality, it's always going to be a balance. So the last communication we've had from the Fed is that getting on top of inflation is their #1 priority. Fine. But when Jerome Powell speaks today at the semi-annual testimony, will he give any indication at all, that perhaps he would be a little bit more cautious if the US was heading towards a recession? Would he concede that he won't hike if it's going to be destroying the US economy? How would he respond? And you can see this Fed Chair Powell's testimony is coming up later, okay, in the session. So the more dovish he is, then we could see a correction in equity markets. We could see this risk-off tone turning positive. So watch out. If Powell is dovish, we'd expect equities to gain. We'd expect gold to gain on the dollar weakness. Expect Bitcoin to gain. Expect commodities to find some gains, but look at oil. We'll come to that in a minute. That is down nearly 6% on the day and approaching this key trend line. Big moves in oil. We also expect to see yields push lower, and if yields push lower, we'd also expect to see further downside in the dollar, and we'd expect to see upside in things like the pound US dollar and the euro US dollar. So that's something to look for. Also look out for the dollar Swiss franc. We've got this sort of condensing price action, so we could reasonably expect this to fall lower. We could reasonably expect this to fall lower if we see any dovishness from Jerome Powell later on in the session. So that's definitely something to be keeping an eye out in this dollar Swiss franc, and we do remain a dollar Swiss franc sell bias. Okay, any retracements up to that 0.97950 region is suitable for shorting. After the SNB, remember last week, they surprised both short-term interest rate markets and economists by hiking by 50 basis points. That's why we saw sudden strength in the Swiss franc. I was speaking to the Times Radio on Friday, and I was talking about the central bank action and inflation across the world. Do check out my Twitter handle if you'd like to listen to that interview. It's quite an interesting one with some interesting economists who are on the panel alongside me, and it was a significant move by the SNB. Although they, interest rates are only minus 0.25%, the fact that they moved before the ECB tells you how worried markets are about inflation. So if Powell is more dovish tonight, then you'd expect to see selling in dollar yen, upside pound, upside euro. You'd expect to see more selling in the US dollar Swiss franc. So that's definitely something to be looking out for. And you can see, like the SNB now, short-term interest rate markets, this is courtesy of the team over at Financial Source, who I work as an analyst with, and you can see that they're now pricing in a 99% chance of a 50 basis points hike for September. So that should keep the Swiss franc bid. Okay, so expect Swiss franc strength over the summer into that meeting, as long as it looks like the Swiss are going to be hiking interest rates by 50 basis points. It's quite a lot of pricing that needs to be priced in with the Swiss franc. And that's why we saw, 4% gain in the Swiss franc last week, and there's almost certainly more to come. So that's a strong currency we need to look for. Commodity moves. This is interesting. Now, if you look at the commodity moves, you can see here US break-even inflation's in the light purple, and you can see crude in the light blue. If you notice, as the oil prices move higher, inflation expectations move higher, and vice versa. When oil moves lower, inflation expectations move lower. So what we can expect is, if commodities keep moving lower, that does bring down inflation expectations. And we are seeing heavy selling in oil at the moment. And what's happening, the reason commodities are falling, let me tell you why. Yeah, it comes down to the growth outlook. If you look at this forecast for how the US, Australia, Canada are expecting to do over the next couple of years, do you notice how growth is expected to slow in Japan, the Eurozone, Canada, Switzerland, the US, Japan, United Kingdom, most slowing due to coming there. The only economy that's expected to pick up is China. Remember, I showed you where the China 50 index is at a different place to the other equity indices. So what we can see here is slowing global growth, and that's what's being projected. Now, that slowing global growth is what's starting to weigh on commodity markets. Okay, so let's take a look at commodity markets. See, copper is down to that $4 a pound level. Okay, that is bearish, and that development down through that trend line, that's a bearish development on copper prices. You see, it's pushing down through 4, and it's a near-term trend line, and that's opening the way for more selling down to 3.75, and then if 3.75 breaks, it's down to 3.5. So watch out for that. That is a bearish development. We can also see oil prices look down, what is it, nearly 6% on the day, and crucially testing that very important trend line just down at the bottom here around that 105 region. So very interesting here. We can see price moving lower. We are at a near-term support. We don't want buying this, but this is what's happening. These markets at the moment are focusing on the growth outlook. So remember, what will support that growth outlook is if the Fed's dovish. Because if the Fed's dovish, it means the Fed won't have to hike interest rates so aggressively. They might pause, and that would give risk assets an opportunity to rally and recover. So all eyes on Jerome Powell. If Powell sticks to his guns, if he maintains the fact that I'm going to be really hiking to deal with inflation, and that's the #1 concern, and well, if we have to have a recession, we have to have a recession. If he takes more that tone, then expect more downside in equity markets and more selling in global indexes. Right, that's what's going on today. Okay, so that's the big picture. Now, in terms of opportunities that we potentially had, was this Canadian inflation data. Now, the pair we're looking at today was the pound CAD. Now, we had the inflation data out this morning, and remember what's going on in the UK. What's going on in the UK is we've got stagflation. Now, stagflation is high inflation, low growth. The Bank of England have forecast that GDP for 2023 is going to be negative. That has been weighing on the pound recently. And if you notice in COP positioning, you'll see that there's been a lot of selling in the COP positioning, and you can see that the pound aggregate position is one standard deviation to the downside with minus 140,000-ish contracts. So pound selling has been pronounced and has been quite in play for some time. So we weren't expecting further pound selling unless there was some really, really bad news. The best opportunity would come with some good news. Now, usually inflation will trade this way. High inflation, strong pounds because there's tighter monetary policy. Low inflation, low pounds because it's looser monetary policy. But because of the stagflation fears, what I was expecting today is if we had a miss of a reading, so say the reading came in below minimum expectations, below 5.6, month on month below 0.5, headline below 8.8, I was expecting that to boost the pound because then the UK wouldn't have to worry about stagflation so much. So conversely, it might have been a bit of opportunity for the pound to rally. Okay, it would have to be a very high reading, you know, probably above 6.5, above 10%, maybe 10.5%, although the Bank of England are expecting inflation to go up to 11. So they're seeing a bit counterintuitive moves we're seeing potentially in inflation at the moment. Because remember, you're always looking at growth and inflation. They're the most two important parts of an economy, and it makes sense that the market might suddenly focus on growth. And that's what commodity markets are doing at the moment. They're not focusing on inflation, they're focusing on growth. That's why commodity markets are selling off. Except it's not UK growth, they're focused on global growth. So that means there was a slight bias for pound gains. We have seen a lot of selling price action in the pound recently. We just take a look, let me show you, let me just take a look here. You see, look at the pound. You can see how the pound has been sold off quite heavily from Feb. So we're quite near low positions. So we're expecting a little bit of a potential retracement on, you know, on a miss, an inflation print. That might be relief that stagflation is a pound upside. And then what I was looking for is this Canadian data. Now, Bank of Canada is, again, a totally different place because what the Bank of Canada are doing, they are very hawkish, looking to hike interest rates, but a lot of that hawkishness has been priced in. So the best opportunity for CAD was going to come from a CPI miss because it means that the Bank of Canada would have to be less aggressive. But there's a couple of things to point out with this is that, yes, I'll show you for 21st. If you look at yesterday, we had some more good data out for Canada. Right? We had the new housing price index up for the month-on-month reading, May, down for the year-on-year, and Governor McNamara be worried about housing. So the fact that that stayed up, yes, it's a bit of a miss on the year-on-year, but it's still very respectable, 8.4%. So no worries about housing. And then look at the Canadian retail sales. Look, 9.2%, month-on-month, above 0.9%. So that was good. So we had two bits of good data out for Canada. And now today, we've had another good print for the CPI. And look, the core is above 6.1%. So that means that expectations are going to increase for interest rate hikes from the Bank of Canada. And at the moment, there's a 94% probability of a 75 basis point hike. So unfortunately, there's no trade on the pound CAD. Because the situation I was looking for in the pound CAD was if we got a miss in the Canadian data, and you can see that potential trend line, and then be looking at buying from this point. But it's just not there now. And the reason it's just not there is that, you know, with the inflation level quite high, yes, we're above that trend line, and that is bullish in technically, but we really wanted to see a bit of a deviation in the Canadian inflation data. I want to see reasons for the CAD to weaken. The other pair I was looking at was the CAD Swiss franc. Now, I do still think there's a sell bias here. I think that is still reasonable to sell at market. Stops above 0.7500, looking for another leg lower down to that 0.7350 region. I do think that is, yeah, just above about, yeah, just into the 0.3770 region. So I can see there being sort of about 70 points. It's not a trade I'm taking, but I can see that it's pretty legitimate there. You've got a hidden bearish divergence. We've got the Swiss National Bank that hiked interest rates by 50 basis points. We should see more CAD Swiss franc downside. The only reason I'm not trading this is that the CPI is high again. You see, it's come back in 6.1. If that was a miss, that CAD Swiss franc would have been a lovely trade from market just down to 0.7370. So unfortunately, it's not a trade. Now, the next thing to be looking at is the inflation data out of Japan. Now, inflation, right? Now, let me just see. Yeah, here we go. Just want to get the right date on, 24th of June. And let's just get the here we go. Right. So inflation at the moment is 2.5%. Hang on, I'll just show you. I want to show you something. Just 1 minute. I wanted to show something. Right, I'm going to send you the link to an interview I did with the Times Radio. It's just in the chat box, and you can see that my comments on inflation start at 8:40. Okay, so you can check that out. Right. Now, if you look at the inflation rate, the core reading is 2.1%. Now, the weak yen is increasing inflation for Japan. Now, Japan's a bit torn because a weak yen is good for exports, but bad for imports. So you think of all the Japanese car manufacturers, you think of Toyota, etc., etc. A weak yen means that their exports become cheaper and more competitive. That's great news for Japanese exporters. But Japan has to import a huge amount of energy. It doesn't have a lot of energy in Japan. So it's a huge importer of energy. So the recent energy prices have resulted in inflation rising in Japan. As you know, Japan has had deflationary forces in it for years. As long as I can remember, Japan has had deflationary forces. Now that has been very difficult for Japan to manage. And as a consequence of Japan's very low inflation, they've kept ultra loose monetary policy. Now, last week, they kept that. They said, we're going to keep interest rates low. We're going to keep the yield curve control in place. We're going to keep the yen weak. Now, just so you can see how weak the yen has been. Right, just look at this here. This is a basket of the yen, and you can see since like the start of the year, the yen has just been so weak. It's lost so much value, right? Now that is made worse by oil prices. So you see oil prices, when oil prices rise, that weakens the yen. And if we just inverted oil prices here, so this is it's going to invert oil prices. You can see how closely oil prices actually impact the yen. Do you see? See that close negative correlation, right? So the yen's influenced by oil prices. It's also influenced by 10-year yields. So if you look at the path of 10-year yields, and let's just inverse 10-year yields as well. Do you see, right? So 10-year yields, oil prices all heavily influence the yen. Now, we've got that inflation data coming out. So if it comes in a high number, so think if it comes in like 2.1 is expected, say it comes in about 2.5%, then you might see the yen start to gain, because traders will start speculating that perhaps the yen is going to have to react to that weakness, and that perhaps it's going to have to hike interest rates to try to dampen some of that inflation. Now, the Bank of Japan see most of that inflation still coming from energy prices, so they're reluctant to hike interest rates. They maintain their very loose monetary policy, but a high inflation print here will put pressure on the Bank of Japan to potentially act. So watch out for some potential topping action around this dollar yen. This would be very, very interesting. And if we saw very high inflation print coming in on Friday, watch out for this being a local top in the dollar yen. So that's one currency pair to be looking very, very closely. And of course, if there's any intervention in the FX markets, and either the Bank of Japan or Japanese government intervenes, then look for sudden downside in the dollar yen. That will be the best opportunity in this current market environment. Okay, folks, a bit of a slower trade today. Are seeing a bit of downside in 10-year yields. We'll quickly look at gold. Gold is a great potential play for a stagflationary play, and we are seeing some gains and some upside in gold at the moment. But in order for gold to keep gaining, what we really need to see is real yields falling and the dollar falling. So one thing to potentially look out for is if we do see a dovish Jerome Powell later on this afternoon. If Jerome Powell is dovish, then you'd expect real yields to fall, the dollar to fall, and gold to move higher. So if you just notice, when you have real yields, which is the light blue, and you have the dollar index falling, gold really gains. So falling real yields, falling dollar, gold gains. Falling real yields, falling dollar, gold gains. Rising real yields, rising dollar, gold falls. So at the moment, we've had rising real yields, rising dollar, and gold's been falling, but those falls have been capped. If we now see real yields and the dollar starting to fall, this could be a nice bit of upside for gold. So look out carefully for gold upside if we see a dovish Jerome Powell later. Okay, folks, we will be back, of course, next Monday for the normal look ahead. And same time as the workshop, but on Monday. In the meantime, I hope you have a very good week. Enjoy your trading, and don't forget to come back on Monday, and we will look at the top risk events ahead. Thanks everyone now, take care and goodbye.